This is level 2 of the CFA program, the topic on equity valuation, and the reading on free cash flow valuation. I would like to tell you that since we have spoken about free cash flow in multiple previous readings, that this reading is going to be somewhat of a review. Let me just remind you that I define free cash flow in kind of a general sense as the amount of cash remaining after all expenses have been paid and after all investments have been made. In other words, it's the amount of cash remaining that is available to shareholders. I wish I could tell you that. Then I could probably hit the stop button and we could move on with our lives. However, this reading is really about layers of free cash flow. Let me show you what I mean here. So look at that first LOS. Compare free cash flow to the firm and free cash flow to equity. So in previous readings, we were kind of thinking about free cash flow, kind of in a general sense. Now we need to slice it into some of its components. And so each of these learning outcome statements relate to both free cash flow to the firm and free cash flow to equity. And we're going to try to figure out how to compute these. We're going to try to figure out how to use them in some kind of evaluation model. Now, once again, this is not a short chapter, and those of you who have looked at this particular reading will note that there are lots and lots of financial statements in there, lots of really good examples. And so you shouldn't be surprised if our LOSs spill over to a second slide deck. But look at that top one there on this slide. We have a single stage, 2-stage, and 3-stage. We did all of that stuff back with the Myron-Gordon growth model, in addition to computing something called terminal value. And so all we're really going to do is take what we learned here. Let me do it this way. Take what we learned here on this first slide about computing free cash flow and then go ahead and apply it to that Gordon growth model. Now, we're not going to call it the Gordon growth model. We're going to call it 1 and 2 and 3 stages. So here's a brief recap. What did I say to you just a moment ago? Free cash flow is the after-tax cash flow available for distribution too. Now, notice that now we're being a little bit more specific. Free cash flow, there's an F there, to the firm. So I want you to think about free cash flow to the firm as the entire right-hand side of the balance sheet. These are sources of capital. So where do business leaders obtain the capital to invest in positive net present value projects? Well, they get it from the bondholders there. That's in purple in the middle. They get it from preferred shareholders. That's in blue on the right. And they get it from common shareholders. That's in dark red on the left. And notice that we've put those circles as looking like they're about the same size. But it's going to be super important as we go through this slide deck to be able to adjust the size. Sometimes the common stockholder circle is super big. Sometimes the bondholder circle is super big. So that's the concept of leverage. And all the stuff that we learned from Modigliani and Miller applies to that. Now, I will say this, the preferred shareholder blue circle over on the right, for most firms, that doesn't even exist. And for firms that have preferred stock outstanding, that circle is really, really kind of tiny. Can you see that there? Nevertheless, the reading talks about preferred shareholders, so we need to make sure that we include that. Although I tell my students regularly that I don't really have hardly anything interesting to say about preferred stock. All right, so look at the second diamond point. Free cash flow to equity is the cash flows available just to common stockholders. We're looking at that burnt red circle over there. And that's the big difference. Free cash flow to the firm is the entire right-hand side of the balance sheet. Free cash flow to equity is the entire bottom right-hand side of the balance sheet. Let me just remind you, these free cash flow models are pretty relevant and can be used to value the firm in the most obvious case when the firm doesn't pay dividends. Remember the Myron-Gordon growth model, the dividend growth model relied on the firm paying dividends. Well, if a firm doesn't pay dividends, then you can use these models just to substitute free cash flow in for dividends. They're also highly useful when dividends are unrelated to the net income or the performance of the firm. I mean, think about it this way. If you were trying to evaluate a professional golfer's performance like Phil Mickelson, and you want to decide, is he going to shoot a 75 or a 65? And you use the number of times that Phil hits his ball into a sand trap model. Of course, if you hit it into the sand trap, it's harder to make pars or make birdies. Now, if you or I hit it into the sand trap, no offense to your golfing skills, we'll probably shoot 100. But even if Phil hits it into the bunker, 9 times during a round, he's super talented. He could probably get it up and down for par or birdie. But my point is that sometimes dividends and free cash flow and profitability, sometimes those things are way off. And so what did Modigliani and Miller teach us a long, long time ago back in 1958? That the value of a company is based on the quality of the assets, the ability of those assets to generate cash flow. So that's what we're talking about here. A third good reason, controlling interest, of course, if we're an acquiring firm or we're an analyst trying to figure out total value, then it's probably good to use this free cash flow model. Look at the bottom there. Free cash flow approach is inappropriate for rapidly growing companies. Boy, we put that in a note at the bottom because if I were creating these questions, I would have a sentence somewhere in this long vignette where it says something like, this firm is rapidly growing, right? And then down somewhere buried in the questions, number 4 or 5, I would say something like, should we use the free cash flow model here? And you just hit the button that says, absolutely not, rapidly growing companies. All right, let's get into this first super important LOS. Compare free cash flow to the firm, free cash flow to equity, approaches to valuation. All right, so notice what we've done there in the middle. Free cash flow to the firm is just the sum of all of the free cash flows to the firm in the numerator, right? T equals 1 and 2 and 3 all the way out to infinity. And we're going to discount those by the weighted average cost of capital, because what did I just say? Free cash flow to the firm, think about that's the amount of cash available from the right hand and to the right hand side of the balance sheet. So you want to discount it at the appropriate discount rate, which of course is the weighted average cost of capital. Now, free cash flow to the firm is preferred when, in addition to all of those other conditions that we talked about here just a few moments ago, but when free cash flow to equity is negative, all right? Negative free cash flow doesn't really make a whole lot of sense. So we can substitute free cash flow to the firm. We also do this when, here, let me go back here. Look at that, look at the middle block there, right? When the bondholder circle is really big, right? So when the firm is highly leveraged and when the firm has a volatile capital structure. Here, let me quickly go back here again. So forget about the blue circle here. Think about the common stockholder circle and the bondholder circle. So think about what a volatile capital structure means. It means that the common equity is going like this and going like this, and bondholder is going like this and going like that. So if you have volatile capital structure, you need to use free cash flow to the firm. Now skip down below the little pyramid there. Free cash flow to equity, on the other hand, is not free cash flow to the firm in the numerator. It's free cash flow to equity in the numerator. Time period T equals 1 all the way to infinity. But then we're going to discount it using the required return on equity, which we might get from the capital asset pricing model. We might get from the arbitrage pricing model. We might get it from, hey, how about we get it from Jim's pricing model? But somehow we're going to use risk. Maybe it's beta, maybe it's some other kind of a lambda or whatever kind of a variable we want to use to capture that sensitivity. We're going to use that as a measure of risk to come up with that required rate of return. And then this is probably an important circle point down in the bottom. When the company has a relatively stable capital structure. That should make sense. All right, let's talk about the ownership perspective implicit in this free cash flow to equity approach. All right, so two ownership perspectives, right? We can have the perspective that we're some big firm out there and we want to take over this target firm. So we want to take this entire thing. We want to know what is that value of the equity from a control perspective. We want to know how much the equity is worth, so that we can attach a premium to it. Remember, in our merger and acquisition chapter, we talked about the average takeover premium is about 50%. So we want to know exactly what that value is because the market's going to expect us to pay a premium. On the other hand, if we're just a regular shareholder like you or I, and we own maybe 100 shares of Harley Davidson or Johnson & Johnson, we're a small ownership, right? The reading refers to it as a minority shareholder with no direct control over the firm's dividend policy. So that's important. All right, look at the bottom there. Reasons why this is preferred relative to the discounted dividend approach. Some firms pay low or no dividends. And remember, the dividend policy is determined by the board. And so the board could say, hey, look, we have this much net income. We have this much operating cash flow. Can you guys even see my hands? We have this much in free cash flow. We're going to pay a 5-cent dividend, right? The board of directors could be totally conservative in their approach, and that kind of delinks the dividends from the actual quality of the firm. And I like that third arrow point down there. Free cash flows may be more related to longer term profitability. And that's really what we're trying to do here. Whether or not we take the ownership approach or the minority shareholder approach, we're interested in long term, right? This is what Milton Friedman taught us. This is what Modigliani and Miller taught us. All right, here's one of those LOSs that is really long and is going to require us to pay lots and lots of attention to the details. So the LOS says something like, suppose that the CFA Institute gives you something. How can you use that something to get to both measures of free cash flows? So this is what we're going to do. We're going to need net income. We're going to need EBIT. Then we're going to need EBITDA. And then we're going to need cash flow from operations. So whatever's given to us, one of those 4 financial statement variables, we're going to have to go ahead and compute free cash flow. Now, these next handful of slides are filled with formulas that you should be familiar with from level 1. And so I'm not going to spend a whole lot of time on them other than just to remind you exactly what they are. So look at this, free cash flow to the firm. You start with net income, which, right, that comes from the income statement. So we had revenues minus expenses, minus taxes, minus depreciation, minus all that stuff. But then we need to add back those net non-cash charges, depreciation and amortization, anything else that the Institute thinks it can throw in there. Add back the tax advantage of the interest, and then subtract out. Now, what did I say to you earlier? Free cash flow is the amount of cash remaining after all expenses have been paid. So that's that first part right in there, those 3 variables that I just described. But then the next part was, and after all investments have been made. So the FC, fixed capital investments, think of that as long term. The WC investments, think of that as short term. So we need to take out our investment in long-term positive NPV projects and then take out our investment in short-term positive NPV projects. Let me give you just a quick example. Those of you who have been paying attention to my previous recordings will know that I like to give the example of Jim and Jim's Bakery. Let's suppose I'm Jim's Bakery and I make donuts. And I wake up one morning and I come into work and I say, I have a great idea for a new donut. We're going to put cauliflower inside of this donut and we're going to sprinkle it with broccoli on the outside. Now, that might sound disgusting to you, but I'm going to say, hey, you know what? I'm the decision maker. I believe in this product line. So what do we have to do? I need to buy a machine. So I'm going to subtract out, let's say it's $100,000 for this machine that can make these cauliflower and broccoli donuts, right? So a minus 100,000, that makes sense. But then I have these working capital requirements, short term, right? What am I going to have to do? I'm going to have to take some of my cash and invest it in broccoli, take some of my cash and invest it in cauliflower. So I'm going to have a big old pile of broccoli and cauliflower sitting over there in the corner. So I need to take out those short-term investments. Now, the LOS asks us for these other non-cash adjustments, and this is going to be one of those areas where you're thinking to yourself, all right, I really need to think like an accountant. Let me go through all of these. And we could go through all of these, but I'm just going to offer you a shortcut here. You remember when you were in 5th grade and someone said to you, hey, we have to memorize these 10 things, but 8 of them are all the same and 2 of them are not. So let's just memorize the 2 that are not, and then we know about the rest. And that's what I'm going to do here. So we put the subtracted in the red. So just remember that restructuring income, capital gains, and tax assets, those are subtracted. Everything else is going to be added back in. Now let me go ahead and address that one part of the LOS using EBIT and EBITDA to determine free cash flow to the firm. So we're going to start with those 2 variables, and we're going to add depreciation, and we're going to subtract out long-term and then subtract out short-term investment. But if we're given EBITDA, what we need to do is adjust it by the tax rate there in the bottom. So look at that second equation. They pretty much look the same, but under depreciation, we need to take the tax advantage, not the full depreciation expense. Now, how about if we're given cash flow from operations to determine free cash flow to the firm? Well, we'll start with that cash flow from operations. We'll add back that tax deductibility of interest, and then we'll subtract out our long-term investment because look at that block point. We're already subtracting out that working capital investment, right? Cash flow from operations. So somewhere there's going to be, broccoli expense or something like that. Keeping along with the same line, here's another series of equations that you're probably just going to have to memorize. And there's no 2 ways about it or no getting around it. But what we thought was that we're explaining the appropriate adjustments. So we thought it would be good for us to go through an example in which we're going to go ahead and calculate those free cash flows, both of them, using all of these equations. All right, so here we have a firm, 2019 and 2020. There's the income statement. So we start up at the top with 294. We work our way all the way to the bottom, assuming a corporate tax rate of 25, and we get around 85 million in 2020 and about 50 million in 2019. Nothing super interesting about this. Just look for some kind of an income statement in the body of the vignette. And then, of course, look at the balance sheet. And so what we've done is we've put the assets in black. We've put the total liabilities in red and the equities in blue. So 596 of assets, 596 of assets. So be prepared to see an income statement and a balance sheet. And then the question will be something like, well, look at that LOS. Go ahead and see what you can come up with, right? Here's a whole bunch of stuff, right? Here's dirt, and here's mulch, and here's flowers, and here's bushes. Here's all this stuff. See if you can plant this in a beautiful landscaping arrangement. So here we go. Estimate both of the free cash flows, starting with net income, EBIT, EBITDA, and cash flow from operations. Now, what I'm not going to do is I'm not going to go through these, but what I want you to do, I just scrolled through them quickly. What I want you to do is pause the video and work through the mathematics of here so that you can go through this. Some of you might be able to go through it quickly in a minute or two. Some of you, it might take 10 minutes. But what you'll see, if you take your time going through this and then through this, you'll come up with the same, what is that? free cash flow to equity 775. Free cash flow to the firm is a minus 2650. And I want you to go through each one of these and take a deep breath and say, okay, you know what, you say this, go ahead and say this. You could say something like, oh man, Jim, when you put this up there, I'm thinking, oh, how am I ever going to do this? But now when you see the math, you're thinking, okay, what did Jim teach us? He taught us about the amount of cash remaining after all expenses have been paid and all investments have been made, and then we're just layering it with all of these other accounts. And I can assure you that if you go through this now, and then you go through this in a week or two, and then you go through it one more time before the exam, that you'll be able to get these. 3 times is the charm. All right, I just took a deep breath there. For those of you who paused the recording, let's move on to approaches to forecasting. So what have we done in that last example? We were looking at historical accounts, and we were just going to come up with free cash flow today. But now we want to look at free cash flow in the future. So how are we going to forecast this? Well, we forecast just like we forecast everything that we do in our life, right? If we want to forecast how much rain there's going to be in our backyard today, well, we go outside and look up first, and then we get out our phone and check the radar, and then we turn on our computer and see what the weather person has to say, and we do all that research. So we're going to do the same thing. So what we need to do is we need to apply a constant growth rate. And how are we going to do this? Well, we can use historical growth rates, but we can use some other kind of an expected growth rate as well. And then we can forecast each component: net income, these non-cash charges, short-term investments, and long-term investments as well. So notice that bottom arrow point down there, super time-consuming. You know, forecasting is not going to take you 2 minutes. So you're probably not going to get an exam question that says something like, here, take the next 4 hours and forecast these free cash flows based on all of these accounts. And so the Institute will absolutely ask you that question, but they'll offer you some shortcuts. And so we need to find those shortcuts. And that's why we put in bolded blue there, a flexible and realistic forecasting approach, one that is not totally time-consuming and overwhelming. Well, it makes sense that if we're going to estimate and forecast something at the bottom of the income statement, like net income, which we can then use to forecast free cash flows, it makes sense to go ahead and start at the top, right? So sales-based forecasting method. Some assumptions behind this model is that our investment in both the long term and the short term have a pretty strong, in fact, the reading tells us, a constant relationship to forecasted sales. In other words, if Jim's Bakery invests $100,000 in the broccoli and cauliflower donut machine, that's going to increase sales by some amount, right? And whatever that amount is, it's going to be the same over time. Capital structure is constant as well. Think of it as being stable, so stable that it doesn't move. We can look at new investment and view new investment as those expenditures required for that growth rate to be sustained. And then we're only going to look at depreciation. Required input, so we need sales growth rates, operating margins, we need relationships between incremental long-term investments and short-term investments and the increase in sales, and then that debt ratio. And so there's a good formula for free cash flow to the firm and free cash flow to equity based on these forecasts. And notice that they are super similar to what we've done before, with a little bit of a slight adjustment to reflect the forecast. What better way to describe the approaches than to go through an example? So let's go ahead and look at some information that's given to us in the body of the vignette, all this stuff that we need. And let's go ahead and forecast these. All right, so sales growth. So what are we given? I'm going to toggle back and forth here. So what are we given? 116 over 2320. So our sales, whoops, I went the wrong way. Our sales growth is 5%. And then our operating profit margin is a similar ratio. That gives us 15%. And then our incremental long-term to sales and our incremental short-term to sales is 50% and 25%. So from that information at the top third, what we can do is we can focus on the middle third and then go ahead and compute sales. And then we can compute EBIT. And then we can take the after-tax EBIT, right? And then we can compute incremental short-term and long-term. And then all we've got to do, free cash flow to the firm, we take our operating income, the EBIT, multiply that by 1 minus the tax rate, right? So that's kind of like, right? That's kind of like cash available. Then we're taking out capital expenditures. There's long-term and short-term. So that gives us 187 in free cash flow to the firm. Moving on to the free cash flow to equity model and the dividend discount models. This is a little bit of a review of what we said earlier, but it's important to address this specific LOS, right? Free cash flow to the equity takes a control perspective, assumes that the recognition of all those revenues is immediate. This is something that I didn't say before, but something that's emphasized in that reading, and it probably is a likely exam question. However, that the Myron-Gordon growth model, the dividend discount model, is of course a minority perspective, but we need to always take a step back and say, all right, are the dividends and long-term profitability, are those things, geez, can I even come up and say, do they have a correlation coefficient of 1? Probably not. Do they have a correlation coefficient of 0.8? Probably not, but there's some correlation coefficient. Maybe it's 0. If it's 0, then we just throw that out and use the free cash flow model. This is a fascinating LOS to me. Explain how dividends, share repurchases, share issues. All right, so you ready for this? If you go look in the reading, there's a paragraph that says, wait a minute, didn't we just tell you that free cash flow is the amount of cash available to the shareholders, right? And so what are the shareholders going to do? Well, the shareholders, now through the executives, of course, have already paid all of the expenses, right? So we don't owe anybody any money. We've already made the investments. We've paid the short-term, we paid the long-term investments in positive NPV projects. So what else can you do with it? Well, you can pay a dividend or you can repurchase the shares. So we put together this little table, but in the reading it says dividends and share repurchases and issuance of shares have no effect on free cash flow. So this is an obvious one here. Now the one caveat here, change in leverage will probably affect in a small amount the free cash flow to equity. I'm not going to go all the way back to those 3 circles, right? Forget about the preferred stock circle, but focus on the difference between the common stock and the bondholder circles. If those things change, a decrease in leverage will probably decrease that free cash flow to equity immediately, but then it'll probably increase it in future years. So small effect, we have that in in bold, and then we have an asterisk over there. So just remember that there might be a small effect there. Some currently, but maybe some in the future as well. And by the way, that probably is a good question, even though, really, it's only one small paragraph out of this, were there 1,000 pages in this reading? Not that many, but, sometimes it seems like it. All right, evaluate the use of net income and operating income as proxies for cash flow valuation. Let me go back to my Phil Mickelson example. Phil's a great bunker player, right? So if he gets in the bunker, really, the audience yawns, the announcers yawn, we all yawn. However, we go and think, okay, we know Phil's going to get up and down and make par or birdie, but how is he going to do it? And that might be in spectacular form. So net income, EBIT, these two accounts can be way off in their relationship to free cash flow. So really just look at the first two diamond points in each one. Poor proxy, poor proxy. But remember this, so net income is a poor proxy for free cash flow to equity, and operating income is a poor proxy for free cash flow to the firm. You know, it's kind of my contention that those accounting things, they're just poor proxies for the quality of the assets. And that just, for me, goes back to Modigliani and Miller. But forget about what I say and what I've learned over the years. Make sure that you pay attention to what's in the reading, because that will be tested. All right, here's this important LOS that relates back to our dividend discount model. So let's read this. So single stage, 2 stage, 3 stage, we could put 4 stage and 10 stage and 35 stages, but we'll stop at that 3 stage. So the single stage model, look in the purple box. So this is analogous to the Myron-Gordon growth model. I've been saying that. You should remember that it's used for mature firms in mature industries, like a company, Harley-Davidson, right? We've been making motorcycles for thousands of years. It's a mature industry, right? Target audience, target market is pretty well identified. It's not like if Harley sells 10,000 motorcycles this year, they're not going to sell 60,000 next year. That's just not going to happen. Assumptions in this simple model, constant growth rate G forever, which is a completely and totally unrealistic assumption. However, it works way better than you would think mathematically. All right, so the value of this firm is, I'm guessing that you're thinking, oh, hey, that looks just like Myron Gordon taught us way back in the 1950s. But notice what we've done. We've put the 1 and the 0 subscript in there just to make sure that you don't make the mistake. Look, when you read the question, whether you're given free cash flow to the firm or free cash flow to equity or Jim's measure of free cash flow, the Institute has to tell you when it occurs. Is it current? Is it today's? Well, then that's 0. If it's 1 year from today or expected 1 year from today, well, that's 1. And you cannot interchange those two. So make certain, look at that top formula there, make certain that you put the expected year 1 free cash flow to the firm and then year 1 free cash flow to equity as well. But those should look super familiar to all of you. All right, so what are we using this model for? A super mature firm who has a reasonably stable, let's call it constant, a reasonably stable growth rate over an infinite time period. But what about a firm that is not a mature firm and not in a mature industry that has 2 periods of growth? Right? A multi-stage model. So it makes sense that if a firm has a huge positive NPV project that it's going to undertake, that's going to result in super growth, right? So maybe that growth rate lasts 2 years or 3 years. It's not going to last for 100 years. It's probably not even going to last for 10 years, mainly because other people, other businesses are going to look over and say, wait a minute, look at Jim. He's selling 1 million broccoli and cauliflower donuts every day. And look at Jim. He has a house at the beach. He has a new John Deere tractor. He's going up on the space shuttle. Look at how rich Jim is just because he had this idea. Why can't we make broccoli and cauliflower donuts? So that's going to eat into my profit margins, et cetera, et cetera. So the growth rate, look at that first circle point. The growth rate in the second stage is sustainable. The growth rate, the high growth in the first stage or the first and second stages, those are not sustainable. So all we do is same thing we did back in the Myron-Gordon growth model. We use that big old formula. All we're doing is taking present value. Always remember, when you compute the value, whether it's the total firm value or whether it's the equity value, you're taking a present value. And I'll show you a shortcut here in just a second with the financial calculator. All right, how about if we have a 3-stage model? Then we can have stage 1. Let's suppose stage 1, we have 20% growth and that lasts 3 years. And then we're going to have some competition. So it's going to decline in years 4, 5, and 6 down to, 20%. So now it declines to 12% in year 4, 5, and 6. And then after year 6, we're back to our regular old normal growth rate of 4%. So look at this. Initially, high earnings growth, large capital expenditures, maybe even negative free cash flow to equity. Later, boy, there it is right there in the slide. I said that. Increased competition. Think of yourself looking over at me, and I'm driving my great, beautiful, big old John Deere tractor, cutting my grass. And I'm so happy out there. And you're out there pushing your lawnmower, and you say, I'm going to make a bunch of broccoli and cauliflower donuts, right? Now, you can have a constant growth rate for each stage like I just described, or you can have a linearly declining growth rate in stage 2. I think we called that the H model back in the old days. So this is a perfect illustration that we've put here for you. So stage 1 is super high, maybe it's 20%, and maybe that lasts 3 years. Then stage 2, a linear decline. So maybe it's going to go from 20%, and then in year 4, maybe it's 15%, and then in year 5, maybe it's 10%, and then maybe in year 6, it's 5%. So a linear decline in that growth rate. And then stage 3, maybe it's 5% forever and ever, or I think I said 5, maybe it's 3% forever and ever. So once again, let's go ahead and take a look at a quick example and work through the mathematics of this. So we're given a bunch of stuff here. So go ahead and process this and absorb all of that information. And then let's go ahead and use a simple 2-step free cash flow model to come up with some estimate. All right, so let's toggle back and forth. So we've got 5 years, so percentage sales growth, 15% for 3 years, 4% for the next 2 years. So there we go. Sales growth for 3 years, 15%. For year 4 and thereafter, 4%. All right, you ready? So net income margin is 7.5%. And then that required return on equity. Notice I put in parentheses down there, capital asset pricing model. I'm whispering here. We're not going to use that now, but later on, we're going to have an LOS in which we need to swing back from there. So just put that in the way back of your brain. All right, so we can compute that sales per share. Boy, at the risk of offending you, what did we start with? 9. So 9 times 1.15, that gets us the 1035 all the way out to year 5. All right. And then our long-term investment, right? The chapter insists on using that notation, FCI lowercase nv. I get a migraine just looking at that. So there's our long-term investment and our short-term investment. And notice what I've done for you at the bottom there. I showed you how to compute those. So all we're going to do for that long-term investment is take the increase in sales, right, from 9 up to 1035, take that difference, and then multiply it by the ratio of the long-term investment to sales growth. So there's that 30%. And then we do the same thing for the short-term, the working capital investment. We do the same thing. There's that 18.8. So there's the 405 and the 253. And then if you sum those and multiply it by, let me go back here, the debt financing, 22.5%, you get the 148. And so if you do all that math, you're going to get 266. And notice I put the 266 and the 306. We put those in purple. The next slide is going to show us how to compute those. But this is what I want you to do. If you have this desire, you go ahead and pause the video and just confirm those numbers in the middle of this table. But you should be able to get those. All right, so then the next question is, how do we use that stuff to estimate the purple? So remember, I want you to think about the purple doesn't exist right now. So let's go ahead and calculate that free cash flow to equity. What we're going to do is we're going to take the sales. So there's the 9 times the 1.15. There's the 1035 times our net income margin. We're going to subtract out the change in the fixed long-term investments. So there's the 9 times the 15% and the 30%. And then we're going to subtract out the short-term investment, take the same 9 times the same 15, and then times by the 18.8. And then the debt financing, we'll do the 9 times the 15%, right? There's the 48, and then times the 22.5. So if you do all that, you get 266. And if you want to, you can go ahead and pause the video and confirm the 306, the 352, the 861, and the 895. Now, it's interesting that the reading gives you this equation there, and we went ahead and computed present value. There's the equity value using regular old time value of money principles, and that gives you $20.60. So there's the answer. There's the equity value using free cash flow to equity model. But if you're like me, you're going to scratch yourself on the head and saying, boy, there's no way I'm doing all that math. So I'm going to use my financial calculator. So there are the steps in red down there. So cash flow 0 is 0, cash flow 1 is 266, cash flow 2 is 306, cash flow 3 is then 352. And then what are we doing? And then notice we put in green up there. That's the Gordon growth model. So what's green, that gives you the 2460. So think of it this way. How are we valuing this firm? As a shareholder, remember this is free cash flow to equity. We have a claim on 26 cents a year from now. We have a claim on 30 cents 2 years from now. We have a claim on 35 cents 3 years from now. And then what's in green, that 2460, that's kind of like the terminal value. So that's the present value of everything that occurs beyond that. And so, of course, we need to take the present value. So I equals 7.5 solve for NPV, and there's the same old 2060. And we could have a race. You remember when there was one episode where Jerry Seinfeld had to race his old high school buddy and he got a head start. I promise you that no matter how fast you are using the regular old time value of money stuff, that I can compute that 20.60 using my financial calculator buttons faster than you can. All right, how about a simplified approach here? Remember I said earlier on that this question that the Institute could ask you could take 4 hours. Well, here's an example of how this can be a shortcut. So notice what we're giving you here. We start with current free cash flow to the firm, 175. Then we have growth for years 1 through 3, 45%. Growth in year 4, 36%. Growth for year 5, 18%, and then 6 and after 7.5%. So think of this as we have lots and lots of growth for 3 years, and then it declines because of competition and maybe some other minor variables, right? So this is really just a time value of money question in which we start with a 175 and we compound it out. All right, so 175 times 1.45, look in that first column, that gets you the 253, times 1.45, that gets you the 367, times 1.45 gets you the 533, then times 1.36, that gets you the 725, 1.18, and so on, and then there is the present value. However, you know that I'm going to go ahead and skip to the red bolded in there. Boy, that's all you're going to do. Cash flow 0 is 0, then cash flow 1, 2, 3, and you get the same 77.91 for firm value. Now remember, let's go back here, right? So we're using the free cash flow to the firm model for whatever reason. Maybe it's a takeover or some kind of an acquisition. And so we can use all that stuff that the reading tells us, or we can just use our regular old formula. But now we get that equity value of 77.91, and here this is so sneaky in there. Look in the far right column. So 175 and 525, and then long-term debt 700, and you're thinking, okay, Jim skipped over that. Maybe he did it on purpose, but when you're reading the vignette, you skip over that and you think, oh, there's no way I'm going to need that. Why do I need that? What do I need that for? Well, you need it to come up with equity value per share. We need to take that 700 out of the 77.91 so that we can get some kind of a per share value, which is important if, right, we're taking over a firm. So if our equity value is $13.51 and we look in the Wall Street Journal and this target firm is selling at, $28 a share, we're thinking, oh my goodness gracious, we're not taking over this firm. But it's selling for 10 cents, we're thinking, wow, we can put 100% premium on 10 cents and take over this firm. And then we'll realize all of those synergies that we talked about for motivations for acquisitions. All right, remember when I whispered to you a little bit ago and I said something like, hey, here was that required return. I can't remember what the number was. Was it 7.5%? Or 15%? And I said, hey, we're going to come back to this. We're not going to use capital asset pricing model. We could, the Institute could ask you to use this, but I'm going to come back. And so look at this. Explain the use of sensitivity analysis. All right. So how sensitive are the valuation results due to changes in the model's input? And so we're going to perform a sensitivity analysis on the following variables. So let's focus on that far right purple example, that circle, free cash flow to equity growth rates. So let me go back here. So what did we do? And here we had, no, it wasn't that one. It was, we had 15, 15, 15, 4, and 4. So think about a big old spreadsheet where we can just change those 15s to any number that we want and then recompute and recompute and recompute. So that's what we're doing here. Free cash flow to equity growth rates. But then when we compute present value, oh my goodness, where are we going to get that required return on equity? Probably we're going to get it from the capital asset pricing model, which has input variables of beta, risk-free rate of interest, and the equity risk premium. And so notice that last arrow point underneath the circles. Beta and free cash flow growth rates are the most sensitive. Boy, we put that most sensitive in bold. So make sure you put that in bold in your brain. Look in the orange box there. This is probably a good question. Sources of error in valuations. Growth rates and the duration of growth are difficult to forecast. So let me go back here, right? Just take this quick example. So we have 3 years of 45, 1 year of 36, 1 year of 18. So how do we know those are right? Well, the only way that we can estimate those growth rates is to figure out what our competition is going to do, right? So we have a certain amount of free cash flow today. So we start making these broccoli and cauliflower donuts and we can think reasonably, all right, we're going to capture all of that market. But then our competitors are going to gradually just, inch our customers away by, well, they could charge less for the donut. They could make a better donut. They could say, hey, Jim's cauliflower, that's grown in his backyard, and who knows what goes on in his backyard. Ours are grown organically here in this big old greenhouse, et cetera, et cetera. So, we're going to lose that growth rate. So what was that question here? Yeah, growth rates and duration of growth are difficult to forecast. Remember that. Now, how are we going to approach our computation of terminal value? We're going to do it either single stage or we're going to do it in the multiple stage approach. And we can do this using some of our multiples that we've used for a long time, all the way going back to level 1. So look in the bolded blue there. Terminal value is super sensitive to the growth rate assumption. So here's just a quick example. EPS estimated to be $5 in 5 years. Okay, in 6 years it's estimated to be $5.90. So if the median trailing industry PE, all right, so let me just ask you to recall on all that stuff that we talked about with, the leading PE and the trailing PE ratios. We did all that stuff. If that's estimated, so trailing estimated at 28, then the terminal value in year 5 is closest to, well, all we got to do is take the 5 times the 28 times the 5, right? So that gets us 140. So that's a pretty simple calculation, but notice that the LOS doesn't ask us to calculate it. It just asks us to explain. So what have we done? We've done all these models, and all we're going to do is say something like, what was my example earlier? It was $13, and I said, oh, if the stock price is 28, we're out. If the stock price is 10 cents, we're in. And so that's what these three circles tell us. We're always interested in finding mispriced securities, whether they're overvalued or undervalued. And wherever there is mispricing, then we can take advantage of it. If the stock is fairly valued, then we can sit back and say, oh, wow, Eugene Fama and everybody else got it right. Stock markets are efficient. And I think that takes us through all of those learning outcome statements. There's a lot of stuff in there. I can't imagine that you wouldn't have to compare the two types of free cash flows and calculate the two types of free cash flows, and then use those in the single, two, or three stage. I mean, that's what my focus would be on if I were to create a 6-question multiple choice on a vignette on this specific reading.